Okay, so what if I told you that the supposedly safe act of simply saving your money could actually be making you poorer? I know, it sounds completely crazy, right? I mean, we're all taught that stashing cash in a standard savings account is the ultimate responsible move. And don't get me wrong, having savings is absolutely crucial. But there's this hidden, invisible threat out there, and it's constantly eating away at your money while it just sits idle. That threat is inflation, and it literally destroys your hard-earned purchasing power over time. Welcome to the Explainer. Today, we're laying out a really clear, step-by-step roadmap to show you exactly how to stop losing your money to that invisible threat, and instead, start transforming your everyday savings into real, lasting wealth. We are stripping away all that complex financial jargon. Seriously, no Wall Street degrees required here. And we're going to leave you with a highly practical guide that absolutely anyone can follow. So, let's just dive right into our roadmap for today. First, we'll cover the problem with saving. Next is Phase 1, preparation. Then we'll move into Phase 2, execution. And finally, we'll wrap things up with the investor mindset. Let's jump right into Section 1, the problem with saving, the invisible thief destroying your purchasing power. Listen, to really grasp this, we have to clearly separate the ideas of saving and investing. They are absolutely not the same thing. Saving is all about short-term protection. It's about storing today's value for later use. It is absolutely perfect for things like next month's rent, your groceries, or if you have a sudden car repair. Investing, on the other hand, is entirely focused on long-term growth. It's about putting your money into assets that actually do work for you over time. Saving keeps your money safe from market bumps, but investing actively puts your money to work so it can grow. Let's actually run the numbers to see how this plays out. Say inflation, which is just the rising cost of everyday goods, is sitting at 6% for the year, but your standard savings account is only paying you 2% in interest. Well, that leaves you with a net purchasing power loss of -4%. Your idle money is quietly evaporating. The cash sitting in that account literally buys less this year than it did last year. Think of it like this. A cup of coffee that costs $3 suddenly costs $4, but your savings didn't grow enough to cover that extra dollar. The wealthy understand this game early on, which is exactly why they move their cash into assets that grow faster than inflation. Which brings us to Section 2, Phase 1, preparation, building your financial safety net. Okay, before you invest a single dollar into the market, you absolutely must complete these two preparatory steps. Step 1, build an emergency fund covering 3 to 6 months of your essential expenses. Why? Because honestly, investing without a safety net is terrifying. If a huge medical bill hits or you unexpectedly lose your job, you do not want to be forced into panic selling your investments at the absolute worst possible time. Save first, invest second. Step 2 is tracking all your spending for just one single month. Every single coffee, every forgotten streaming subscription. A lot of folks think they don't have the money to invest, but usually they just have hidden leaks in their budget. Every forgotten subscription is cash that could be buying your financial freedom. Plugging those leaks gives you the exact cash you need to get started. All right, moving right along to Section 3, Phase 2, execution, putting your money to work. $10. Seriously, I want to completely shatter one of the biggest myths keeping everyday people from building wealth. The totally false idea that you need thousands of dollars just to begin. You just don't. In today's digital landscape, there are so many investment platforms that allow you to start your wealth-building journey with as little as $10 or $50. It is incredibly more important to build the habit of starting, even with just $10, than to sit on the sidelines waiting until you're rich to begin. The real reason starting small works so incredibly well is because of two words: compound growth. When you invest, your money earns returns. But then, as time goes on, those returns start earning their own returns. Your money essentially clones itself, creating this massive snowball effect that results in exponential growth over time. So investing isn't just about how much capital you start with, it's heavily dependent on how long you let compound growth work its magic. Time is the secret ingredient that turns tiny monthly contributions into a massive portfolio. In fact, the mathematical power of this concept is so profound that Albert Einstein supposedly called compound interest the eighth wonder of the world. Just let that sink in for a second. The greatest physicist of the modern era was reportedly in awe of the simple math behind letting your money make more money over time. And honestly, he definitely wasn't wrong. Now, the world of financial assets can seem overwhelming, like a giant puzzle, but they generally break down into four main categories. Individual stocks give you company ownership, offering high growth, but they carry very high risk. Bonds are basically loans you make, offering a lot of stability, but with lower returns. Real estate is super powerful, but usually requires a heavy amount of upfront capital. And then there are index funds and ETFs. These are bundled collections of many, many companies. Instead of trying to guess and bet all your chips on one single stock, you invest in an entire market. So if one company fails, your portfolio barely feels a scratch because you own pieces of hundreds of other companies. For beginners, this is very often the smartest, safest, and most diversified starting point. It's simple, and it works. Once you've chosen your investments, here is the golden rule you need to implement immediately. Automate your investing. Do not, under any circumstances, rely on your own raw motivation or memory to manually transfer money every month. Set up automatic transfers from your checking account directly into your investment account. Remember this phrase: consistency beats intensity. Treat your automated investment just like a mandatory utility bill. Pay your future self first before you even have a chance to spend that money. Building wealth isn't about making one giant, stressful financial move. It's simply about repeating smart, automated actions month after month, year after year. And that leads us perfectly into Section 4, the investor mindset, thinking long-term in a short-term world. This is exactly where so many beginners completely crash and burn. They see the flashy headlines and they want to get rich quick. You have to ignore the meme stock hype. You must avoid the fake internet gurus flashing rented sports cars and promising guaranteed returns on random crypto coins. Here is the blunt truth they won't tell you. Real investing is actually quite boring, and that is a fantastic thing. Wealth is built slowly through patience and discipline. The market reliably rewards long-term thinkers, but it will actively punish gamblers. It really comes down to shifting your core identity from a consumer to an investor. A consumer spends money to impress other people. They just want to look rich today. An investor buys assets that generate future income. They want to actually be wealthy later. Before you make your next big purchase, stop for a second and ask yourself, will this make me richer later or just make me look richer today? Because every dollar you earn has two choices. It can disappear into a temporary lifestyle upgrade, or it can be put to work to build your future. Let's actually map this out over a lifetime. It reveals the ultimate secret to wealth. Time matters way more than timing. At 10 years in, you're just building the foundation. The growth might feel a little sluggish, but hit the 20-year mark, that's when compound growth really accelerates and the snowball gets massive. By 30 years, a person who just invested consistently in wonderfully boring index funds will almost always beat someone who constantly tried to perfectly time the market's ups and downs. You do not need a crystal ball to predict the future to be successful. You just need to stay in the game long enough. Saving money might be your very first step toward financial freedom, but investing is what actually turns that freedom into a reality. You don't need to be rich to start investing. You start investing to become rich. Every wealthy investor out there was once a total beginner staring at their very first tiny investment. The only difference is they started, which leaves us with one final, deeply personal question for you to consider today. Will your next dollar disappear, or will it start building wealth? The choice is entirely yours. Thanks so much for joining me for this explainer, and I hope this roadmap serves you incredibly well on your financial journey.